So, a quick recap is always good. So, we are starting off with financial accounting. So, I'll be needing your help, please. So, why financial accounting was necessary? Have we discussed this? Come again, please. Also, the last financial accounting were which we okay, Ji. Financial accounting was about identifying, right? Yeah, that's why I had to stop Bhavji. So I believe it's fine now. You all can hear me. Okay, fine. Okay, we are basically recapturing all the things which we have studied. So financial accounting was about identifying specific elements of a transaction. Then obviously you needed to classify them, and then record, then summarize, and final step was present. Present what? Relevant transaction details. Or your details, they are specifically financial details, quantitative details, right? And we discuss certain elements of business. So business was a legal concern which was carrying out legal activities, and the purpose was to generate profit. Then we had types of business basically. So we had sole proprietor, then we had partnership, and then we had company or corporation. So we discussed different characteristics of these businesses. One thing which we haven't discussed in detail is basically I'm getting to that point. Uh, yeah, more often talked about generally accepted accounting principles, but we haven't discuss these in a separate session. So normally I call them GAAP, right? If not only me, most of the people who are familiar with this term call them GAAP basically. So today I need to discuss these basically, as some of you have requested that we need to have something in terms of theory in exam as well. So we need to have some solid grounds to give you a theoretical question in exam. So that's why I thought that while recapping, so the first one is historical cost principle. So this principle states that record value of asset at cost. So whatever you have paid, you must record that. So this is basically highlighting the fact that you cannot misrepresent the data. So when you have purchased an asset at, let's say, 500,000, you should mention it as 500,000 in books of accounts. You cannot undervalue it or overvalue that asset. So second principle is objective principle, or sometimes called as objectivity principle. So this principle highlights, emphasizes basically, once again, cost element, emphasizes uh, to establish an objective price. So this is for the assets basically. When you are purchasing them, the objective price is basically when buyer and seller agree to it. When they both agree to it, that becomes an objective price. You cannot force somebody to, buy your product at at a price he's not willing to. So objectivity principle states this is specifically for the old assets, because when we are recording our assets at cost, so why do we need it? Objectivity principle, we needed it because sometimes we need to sell our old assets, or sometimes we purchase your reconditioned assets. So the price established between the two parties must be an objective one, means it should be based on certain market mechanism. That is why we had revaluation concept. We have independent revaluation experts who help you define the objective price. Okay, coming to third one, we have discussed this more often, going on concern. So going on concern is basically a business is meant to go forever, meant to go forever. This means that the life of business is basically infinite, right? So infinite in the sense that unknown. So that is why it is
हाँ जी
so going on concern states that business is meant to go forever. So for this reason, when we talk about the ownership rights in company, which are generally called stocks or shares, they have infinite life. Otherwise, when you talk about the sole proprietor or partnerships, they can be the life of business is very limited. For a very small reason, your partnership contract can be cancelled, and when it's cancelled, so that so you need to keep this in mind that your business is meant to go forever. So this is a problem for sole and partners, but for the stocks, it is very well established that going on concern can be implemented. Okay, coming to next principle, which is very important in recording a transaction. So this states that you should only record material amounts. Record material amounts. So once again, I'm using material because something could be material for me, but it's not material for a large business. For example, recording a 5 rupee transaction is very important for me, but for a multi-billion dollar business, 5 rupee doesn't matter. So that is why they record only material. When you're concerned with the banking sector, so they are concerned with paisas even, you know. So you have to have two decimals settled with you. You should be at these amounts. So materiality is generally an a relative concept. It varies from business to business. So that is why we are talking about that rupees 5 is important for me. But for certain business, they would say that we will not be recording any transaction less than 500. So materiality principle states that you need to record material prices, your material amounts. That is why for smaller businesses for which rupees 5 is important, we have replaced it with concept of petty cash. So we have a material amount. Just hold on, please. Sorry. Okay, go. So we generally have petty cash, concept of petty cash involved in business. So this emphasizes the recording of material amount. For example, a company having 5,000 petty cash means that they will be recording only transactions greater than 5,000, let's say. But sometimes, obviously, they keep it separate for us for certain purposes. Okay, Ji. Yeah, I guess I'll have to take this call. Apologies on this once again. Okay, materiality is done. Then we have matching principle. We have implemented all these practically. Matching principle states that revenue and expenditures of same period must be matched to calculate profit. So That's what I was telling, that we have implemented all this practically. So revenues and expenditures of the same period must be matched to calculate profit. So this is basically to avoid those fraudulent activities in which you, let's say, you record 12 months of revenues and expenditure, and plus you record the first month of next year's revenues. So now you have revenue of 13 months but expenditures of 12 months, and obviously you'll be inflating your profits, which is no good for the owners or shareholders. So this is wrong as far as accounting is concerned. So that is why this principle was created to give you a good idea that revenues and expenditures of the same period must be matched, so that the investors would be having a right idea about how your business is performing. Similarly, next is about similar activity, for example, realization principle. So this realization principle states that record transactions as and when they have been initiated partially partially. So this is basically realization. This means they are realized. For example, when we talk about a transaction that I have a contract with ABC to perform services worth, let's say, 50,000. So as far as our practice is concerned, we have treated this as an information. We haven't recorded it. So if this transaction gets slightly changed, for example, he tells us that I have received advance payment of rupees 50,000 for services to be performed later. So this should be recorded, because this is partially carried out. So that what we have done practically. So we don't need to worry about it, that they haven't been uh, familiar with these principles. So we have done these practically, and uh, it is only now that you must feel that okay, uh, they were easy, because at the start when I would have taught you this, it would have been very difficult for me to make you understand that what are these generally accepted accounting principles. Okay, I'm blank at the moment. Can't recall any further. Can anybody help me with any principle, please? Matching realization. Next is disclosure principle. Okay, disclosure principle is basically that all the relevant information for all stakeholders, not just one, all stakeholders must be disclosed. Them. So this is asking us to tell the financial information to the tax department. This is also asking us to disclose all the relevant information to our shareholders. And in fact, all the employees are familiar with your practices, financial as well as environmental. So they are very familiar with your practices. So they, as a stakeholder, are familiar with this. When you are engaging new suppliers or customers, you must clearly state. Okay, so people don't mute their mics basically. So I have to do it myself every now and then. Okay, so I guess we'll take a break, a prayer break for now, and we'll continue after the break now. See you in 10, 10, 15 minutes.
Okay, sir.